So, welcome, Perennial Pride listeners. Thanks for joining me on this podcast today. Really excited to have this conversation, reconnected up with someone I knew in my past life, and he's got a new life too. So, it should be fun to learn more about what he's been up to. So, I have a special guest today, Clive Davis. He's the founder at Park Royal Capital, which is a private equity commercial real estate investing firm focused on acquiring and operating multifamily communities. And so Clive has an interesting background. We're going to go a little bit more into that today. But Clive, welcome to the show today.
Hey Tom, how you doing, man? Thanks for having me on.
No, awesome, awesome. Yeah, we were just chatting a little bit before we started recording, and Clive's got an interesting background and how he got into real estate investing, but and entrepreneurship. But so Clive, before we get kicking off on anything specific, tell our listeners a little bit about your background and how you sort of entered the game of real estate and kind of what you're doing today.
Yeah, so I started out as a corporate transactional lawyer, New York City, Wall Street firm. So I did that for several years before transitioning into the pharma industry. In I think 2001, I joined Pfizer, and that's kind of where our stories interconnected. I ended up spending 15 years in total within the pharma industry between traditional legal in house roles, and then later I joined another pharmaceutical company as their chief compliance officer for their Americas business. So, all in all, I had a 20-year corporate career. And at the end of 2016 is when I tell people that I made my escape and decided to pursue real estate investment full time as a full time real estate investor and entrepreneur. I've now been investing in real estate for 25 years, but throughout most of my corporate career, it was peripheral, more hobby like real
Mhm.
estate investments in a duplex here, much later, a 5 unit, and then an apartment in New York City. So it was never anything that I was reliant upon the income. I was blessed to, for most of my career, have been highly compensated. So I wasn't dependent on any of the real estate investing that I had done at that point. So come end of 2016, moving into 17 is when I really flipped that on its head and said I was going to make kind of corporate my backup plan, and real estate, commercial real estate specifically, and even more specifically multifamily was going to be the primary thing that I was going to pursue. And then I just got on a path of educating myself, putting myself in a position where I was surrounded by people doing this, aspiring to do this, investing in this area. And first I started out making probably a dozen or so investments, passively investing into commercial real estate with a focus on multifamily. And I did that with my legacy kind of retirement funds from
Mhm.
Pfizer and my other employer, that I had moved those funds into a self-directed IRA, and I just started deploying it. And I tended to invest in the types of deals that I aspired to do at some point as the sponsor. And so beyond kind of the ROI that I expected to get, I was also getting some education, albeit from the passive side, as to what do these deals look like? What
Mhm.
does the capital stack look like? What does investor relations look and feel like? And how are these sophisticated institutional players developing these business plans and attracting the capital that they need? So all of that was part of my journey along the way.
That's great. Yeah, and it's interesting because and knowing a little bit more about you and coming from, I would say, humble beginnings, right? You were the first, if I'm correct, the first in even your family to go to college, let alone become a successful lawyer. So this is so why it's interesting to hear because you say, okay, why would you ever get off of that, right? You're making a lot of money. Life was probably pretty good. You didn't need any of this real estate to actually support you financially. So what really compelled you to sort of find this new path, like get off the corporate route?
Yeah, it's a great question. I get it quite a bit. And the answer is kind of a mix of a few things. So, one, I tell people, regardless of how highly compensated you're blessed to be, you cannot pass on a high W 2 income to your heirs. And so I'm very much focused, more so in the last several years, I'm very much focused on being the first in my family to create generational wealth that will not only benefit my children, but my not yet conceived grandchildren.
Mm,
And so, if that's your goal and objective, you can't be exclusively reliant on a W 2 income, which can be here today and gone tomorrow. Someone can come in and say, "Hey, Tom, we love what you've been doing for us over the last many years, but we no longer have a need for that department, or we no longer have a need for you. The company, the corporation's going in another direction." And the company and the corporations, the employees are always going to do what's in the best interest of the company and the business. And I like to think that everyone is expendable. And so you've always got to be thinking about what can I do to ensure kind of my stability and my kind of financial growth. And again, if you're 100% reliant on an income that can be taken away from you, that I think is a very precarious position to
mm,
be in, regardless of how highly compensated you are. So that reality I'd kind of known for quite some time, but started to think about that more seriously. I had my oldest child who was heading off to college at that point in 6 or 7 months. So the reality of the first one kind of leaving the nest and wanting to spend as much time as possible prior to her departure, that was weighing on me. My mom was, for the most part, in poor health in the year plus leading up to that, kind of bouncing between hospital, home, nursing
mm.
home. And so while I was able to support her and my family financially, I wasn't able to physically see her in particular and them in person in the way that I would like. I was traveling to Brussels 4 or 5 times a year, Sao Paulo, Brazil 3 or 4 times a year, Mexico City. I was responsible for the Americas, so these are some of the countries within the Americas for the last company that I worked with. So just the international travel alone was demanding, not even mentioning kind of just the regular domestic travel around the U.S. Um, so all of those things were demanding and drawing upon my time. And what I say is that highly compensated, but my time was not my own. Someone actually was paying for my time.
Right.
And I wanted to regain that control over my time. And I also wanted to pursue financial freedom in a way that I kind of orchestrated, as opposed to, again, being 100% reliant on someone paying me a salary and things not changing and me always being reliant on that. So
Yeah.
those are
Yeah.
some of the things that were kind of swirling around as I made that decision. And it wasn't one that I probably in hindsight, it didn't need to be as abrupt as it was for me in hindsight. I could have probably done some things more in parallel and made for a smoother exit, but no regrets. I did it now 7 years ago and really haven't looked back. And while I'm not as well compensated today, I have the time freedom. I am pursuing that financial growth and that pursuit of generational wealth, and I'm doing it on my own terms. So that's just kind of the journey that is right for me.
That's awesome. That's awesome. And it is quite amazing because we can, being in that world too, you can almost settle in, and this is what life is supposed to be like, and we can have some of those things kind of drive our, not only our occupation or how we spend our days, but like it can really impact the rest of your life, right? All the things, relationships with your family, to your point, like being able to spend time with your kids. And we always joke around like time is our most scarcest resource, and we don't have an endless supply, unfortunately, which we all know. But it's fascinating because I had the same epiphany, and I'm thinking long term about things and how can we change it? Well, the less control we have, the higher risk we have, actually, I
Yeah.
think. And it's just you just have to think about it a little bit. And for those listening, like they really consider that, because we always think of a corporate job and we feel like safe. But the reality is you're probably at a higher risk here and exposed than you may realize till that day happens. But fascinating. So you're using it to kind of reshape your entire life, right? Of how you spend your days and think about kind of future support for your family, right?
Yeah.
Right. So that really
And
helps you.
Tom, when you have children like we do, one of the other things that I was contemplating is what am I modeling for them in
Mm,
terms of what's possible and kind of the future that they can have. And so they'd seen me for 20 years in one corporate role or another, but they'd never seen me attempt to be an entrepreneur, at least in a full-time way and not just kind of in passing. So I was also mindful of, I want them to think, okay, yes, I could do a corporate job, but pursuing something entrepreneurial is just as valid, just as possible and attainable. And so I was mindful of, when it's all said and done, what will they have observed? So forget
mm.
what I say and forget what I tell
Yeah.
them, but what will they have observed? And I didn't want
Yeah.
to just tell them, hey, you can do anything that you want to do, but only show them me doing one thing where I'm beholden to an employer paying me a salary that I'm 100% reliant upon. So that too
Yeah.
was something that I was mindful of.
No, that's terrific. Yeah, and to your point, like you can't say, "Hey, do everything," but I'm just going to stick in this corner over here and not try the 100 other things I might actually want to do.
Yeah.
So you can't be a hypocrite about it. Yeah, that really resonates, and it's they are watching, even though they may not be listening all the time, but they're watching and taking it on for sure. I'm sure that's great. That's great. Yeah, actually, it's funny. It struck me the other day because even my son told my wife, she's like, "Oh, it's interesting. He's home more often, right?" It's different, and it's
Yeah.
like I like that, right? But that's where you have to kind of explore that and say there are possibilities. So that's great. So you kind of mentioned it too. You could have been you had a kind of abrupt sort of transition. Any other sort of big sort of ahas and challenges that or surprises that kind of happened as you made this transition and as you developed your business?
Yeah, many. So the first reality that hits you is after 20 years of getting a direct deposit that hits every 2 weeks, once that abruptly stops, kind of there's a reality to that, right? So I tell people for the first time in my adult life, probably since I was 17, I was seeing more income or more cash leave my household on a monthly basis than was coming into my household on a monthly basis. And that takes some getting used to and wrapping your head around that. And you've got to know the why, right? There's got to be a solid why as to why you are allowing that to happen in pursuit of something. And if you don't have a solid why, you're probably going to return to that comfort zone and return to that twice a month direct deposit because that's what you know. So that was the first reality that hit me. I had to kind of get comfortable with being
Yeah.
uncomfortable in stepping outside of my comfort zone and know that I was doing this for a reason and that I would be able to figure out how to sustain myself until I was able to realize a breakthrough and make some headway in what I was pursuing. So that was huge. Recognizing how challenging it would be to simply, something I took for granted, being able to take some equity out of my home, do a cash out refi for whatever reason. When you have a W 2 and you've got your tax returns, those are the two things they're going to ask you for. When you go to any lender, or at least traditional lender, they're going to say 2 years tax returns and pay stubs for the last 30
Mhm.
days. Well, if you're in my position that I found myself in where I didn't have a W 2 any longer, had I thought about it before exiting, that's something that I could have handled a little bit differently. But even now, I'm still in that situation and I'm actually currently in the process of doing a cash out. And it's one of the most painful things when you do not have a W 2 all of the hoops and hurdles and obstacles you have to navigate in order to do something very simple that most employees with a decent income and tax returns that have been filed take for granted. So these are some of the kind of the small things, but they can be meaningful things that you don't necessarily appreciate when you kind of just venture out on the kind of the entrepreneurial journey. I could talk about healthcare and kind of the reality of healthcare when you don't have an employer and you're on your own. It's your own dime and you got to figure that out. That can be very precarious, and that's a learning curve and learning journey. So things like that, again, things you take for granted as an employee with benefits, that when you become an entrepreneur, it's a different reality. And you probably know exactly what I'm talking about, Tom.
Yeah, it's crazy. And then to your point, until you experience them and have to deal with it, even though you may hear about it, it takes on a different lens when you actually have to physically deal with it or solve for it. But and that's the thing. I mean, that's why there are people where a job is the best fit, given their circumstances, or to your point, their why. And that's the good part is you get to experience now both sides and give your kids a lens to say there you can choose either way. You have the ability to, you have that option, which is definitely a freeing.
Yeah, and for those who not everyone's going to be a real estate investor, no, not everyone has to be. There is a kind of a middle ground, if you will, where if you recognize the benefit and value of investing in real estate, you can do that. You can do that as a passive investor while you continue to enjoy your full time kind of traditional corporate job or role. But even there, I would say you should be exploring things beyond kind of just maxing out your 401k with your employer and doing some 60/30/10 kind of recommended allocation. And while you should be doing that, and I did that for all of my time, but I think that's a bare minimum for far too many people. That's where they're investing in
Mhm.
stocks. And I think that should just be the beginning. And if you do believe what Wall Street tells us about diversification, I definitely think that you should be exploring opportunities beyond kind of just maxing that 401k out at whatever it is today, I guess 23,000 or plus or minus of that. So I encourage people, you've got to have some exposure to real estate. It doesn't have to be the same exposure that I have, but a healthy portfolio, I think, should have some portion of your investments in real estate in some form.
Yeah, no, I agree. And I think we're going to tie this together too, because I want to certainly go through your journey with scratching the itch. Not you completely scratch yourself completely with the real estate bug, if you will. But, we've always talked about, to your point, reconsidering how we invest because I think and from our lens, we think about access and ownership of assets, right? Whether it's your business or real estate or even personal development, to me, those provide a much more lucrative sort of possibility and more control for folks. And it's just we've been trained to just throw our money into a market and let it sit for 20, 30 years and hopefully it'll be there. Not saying don't do it, but to your point that need to start thinking about it and recognizing that there are other options, right? We just have maybe haven't been exposed to it enough, right?
Yes.
So great stuff with that, Clive. One last thing before I kind of leave the sort of entrepreneur journey is I think a lot of these things you kind of learn more about yourself as you kind of transition. What did you learn about yourself as you sort of migrate away from corporate America to sort of owning this business and building it and developing it over time?
Yeah, so when you're in corporate and you go through some kind of skills evaluation and or you do whether it's DISC or any of those kind of profile things and you learn kind of I'm an S or I'm a this or I'm a that. When you put yourself into an entrepreneurial role or get on that journey, that's where you really get to test, are you a people person, are you,
Mm,
especially in what I do, where real meaningful networking is essential to being successful in this space. So i I tell people that I think and consider myself to be an introvert, And most people will say, really? I would never have thought that. And I'm like, I can put myself in situations that call for me or pull out the extrovert in me. But I know that after I'm in those settings, I then need to recharge my batteries. And
Mm.
usually that's alone time to recharge. So that's something I kind of thought to be the case. But again, I went from being in a role in corporate America where yeah, networking was nice, but it wasn't essential to my success of my day to day role. And then to put myself in a role where it's critical to my day to day success, where I'm on the phone with investors most days, you kind of learn and also have the opportunity to improve over time that skill set because there are skills around that. And so that would be like one good example of something that I really didn't think about when I was in corporate. I just needed to make sure that my team was doing the things that they needed to do and getting those things done. But in terms of, I was never a big corporate ladder climber. And maybe had I been, I would have been more successful in that world. But again, it just wasn't as, I didn't deem it as critically necessary as I do now and have for the last several years. And so that would be one example I'd point to.
No, that's really good. And that's why a lot of these things, it's, I think the more you know about yourself and what you're good or not good at or dislike, that I think I think it's a huge sort of benefit because, like you said, leverage wise, you can leverage other people who know different things or operate differently to really help you, right? Achieve what you're trying to achieve. And we get so wrapped up in having to, we have to do everything. At least I was
Yeah.
thinking that I've got to handle everything. Well, the reality is that is probably a recipe for going slow. And you're leveraging other people just like companies do to help them do something that they couldn't do on their own. So, but then staying in your lane or developing the right skills that are needed, right? You got to know that going into it, or at least once you find it out, figure out you got to do something about it and fill that gap because
Yeah.
it could be harmful. So that's great. So let me switch gears slightly because I want to. You talked about when before you just ripped the band-aid off, right? You were investing in multifamily deals as a limited partner, right?
Yeah.
And you got to learn the business a little bit more. So that was kind of part of your education. You're investing, making some money and getting educated, which is a good combination a bit. So when you started getting into doing it for the business, sort of what was that sort of transition like, right? What was the kind of maybe first initial deals and things you got into to really get you going? Because that's probably, I think, probably the hardest part.
Yeah, so as part of that educational journey, I jokingly refer to it as my self directed real estate MBA that I kind of built and put together.
Yeah.
And a big part of that, beyond kind of attending multifamily conferences and surrounding myself with hundreds of people who had similar aspirations or were already further ahead and investing in those deals, I also sought out mentorship and formally enrolled in an apartment investing mentoring program, which again was an opportunity to surround myself and also find prospective partners and what have you. So when I got to the point where I felt, okay, I've done all of the education, I'm ready to start actively pursuing these deals. The first deal that I offered on was in the spring of 2019. And I tell people this because I make the point to let people know I was not an overnight success where I just said, I'm going to buy a 100 unit or bigger apartment community and it just fell into my lap in 2 or 3 months. It ended up taking me the better part of 2 years before I landed that first deal. COVID was in the mix, so that didn't help things. But nonetheless, it took me better part of 2 years. In the summer of 2021, we were awarded and were able to close on a 244 unit apartment community here in Metro Atlanta, where I live. We acquired it for 30 million, and we had to raise 8.25 million in equity to get that deal done. And we closed that in late 21. And 3 months later, we closed on a 200 unit also in Metro Atlanta We acquired that for 40 million and we raised 13 million in equity. And I say we because everything that I'm talking about, I'm part of a team of individuals who came together and kind of combined resources and efforts and skills and what have you. And we went after those deals. So those first two deals took a little while, but once I got the first one, I got some traction. We close behind that, hot on the heels. I got a second one and have just been grinding since then. And while multifamily kind of ownership operation is still the bread and butter, in the last couple of years, I've ventured off into the world of ground up development of commercial
Mm.
real estate, both multifamily as well as mixed use. And so, still under the commercial real estate umbrella, but different skill set, different business models. And I'm learning every day in those worlds, in that arena too. So, yeah, definitely not an overnight success. It definitely required perseverance and commitment and all of those good buzzwords. I got to live that in practice because had I at any point said, you know what, that I really miss that direct deposit every 2 weeks, and that's kind of a safe comfort zone, go back and get a traditional job, I would not be kind of experiencing any of the success or results that I've been able to benefit from over the last few years.
Yeah, no, and you hit it early in the conversation around understanding your why, that what you're trying to achieve here. And because it's going down this type of road, you just got to expect it's going to be pretty painful, at least for some of it. And because just like anything else, you got to learn things and get exposed to a lot of things and maybe get thrown down a couple times. You hear it often enough where it's when these overnight successes sometimes take 15 years. So you don't see this sort of grind in the background. So it's definitely not for the faint of heart, especially the entrepreneurial space. So you got some moving there and you've built yourself good partnerships and teams that you've kind of were able to do this. And so you said a couple hundred units, like how did you guys arrive at that? Is that kind of the sweet spot that you just found was good for your model? And how's that changed over time? I know you mentioned it sort of shifted a little bit. Um,
Yeah, so the mentoring program that I joined and many of the similar mentoring programs tend to teach and advocate that in order for the business model to make sense, for you to have on-site property management as opposed to remote kind of management, you really need to be, the sweet spot is kind of plus or minus 80 units. And so very early on, I was thinking, okay, I want to be around 100 units for my first deal, at least, because those economies of scale, the more units under that one roof or on that one campus, the better the economies of scale. And so that's where I originally set my target. And then the first deal, like I said, was 244 units. The second one, 200. We closed a 295 unit in Northwest Arkansas last year that we acquired for 77 million. We raised 38 million in equity for that deal. What's changed for me is that first deal that I did, which is a 1970s, early 1970s vintage kind of
mm,
C-class asset. That's not a deal that would kind of check the boxes in my buy criteria today, which has kind of evolved up the class ladder, if you will. So higher quality assets with kind of a stronger demographic resident population. So that evolves, and like any good business plan, should evolve and keep pace with what's happening in the market. So I'm no exception there. But for me now to think back, before I got that 244 unit, the real estate that I own personally, the largest thing that I had was a 5 unit. And I went from that 5 unit to the 244 unit. But for me now to go back to doing something 100 units or smaller would seem like kind of instead of making progress, I'd be regressing. So that's kind of the sweet spot in terms of unit count. And while it's not written in stone, that's kind of what I gravitate towards at this point.
yeah. No, that makes sense. And I can appreciate the sort of movement. Even in my personal example, I started like a single family, older property, and now I can't even imagine doing something like that.
Yeah,
It just like too many headaches and potentially, but you kind of evolve and figure that out along the way.
yeah.
And for you, like when you look at kind of today's market, kind of unusual, right? A lot of still headwinds around financing, and I've seen some of that now. So, kind of, what do you guys sort of, as you sort of assess what's going on? Like, how are you sitting? Are you sitting on a lot of cash? Are you kind of just a lot of waiting a little bit, kind of assessing land? Like, where do you see things right now?
Yeah, I'm probably more so being a little bit defensive in terms of kind of just managing my existing deals and getting them through what is somewhat of a precarious period. The run up, and we spoke about this previously, but the run up in interest rates has really been a douse of cold water on commercial
Mm,
real estate. Not just commercial real estate, it impacts lots of areas,
yeah.
obviously, but commercial real estate is certainly interest rates are kind of one of the essential ingredients in determining whether or not a deal is going to work or not. So in my own practice, I've been more focused on kind of the development deals that I'm involved in and getting those across the finish line. And both of those deals that I'm involved in will be breaking ground between the summer and probably early Q3. I've been less when brokers reach out to me now about different multifamily opportunities. For most of the year, I've said, get back to me in the second half of the year. I'm not even underwriting, I'm not even looking at opportunities right now. And deal flow and inventory is down substantially
Mm,
this year compared to last, and certainly relative to 2021 and 2020 and 2019, which was some of the golden years in terms of the number of transactions and inventory. But there is a lot of capital on the sidelines waiting to pounce, so to speak, because the way that we have historically done our deals, where we raise capital for each individual deal, as opposed to sitting on a fund or a pile of cash waiting to deploy it, we're very much subject to the reality that many of our investors, they haven't seen some of their investments be replenished and being in a position to redeploy that into new deals. And so that's something we just need to factor in, because every deal is going to require us to raise those funds. So we're not
mm.
an institutional player who can write a check for 77 million and not have to worry about individuals putting in 100,000 at a time. So that does kind of put into context how aggressive you can be in this market.
I mean, a good thing in at a very fundamental level to having cash on hand. I think it's still a good thing, whether you're a large organization like what you're talking about and having needing potentially millions, but even just from a personal household, having some good leverage and cash available is probably a good thing. We always talk about
Absolutely.
always being invested. Well,
Absolutely.
people who are a little bit more savvy, like you, like recognize that there's there's importance on buying it right, and you may not be able to time everything perfectly, but as long as you're kind of directionally correct, you're going to probably do better, right? And having cash is always a good thing, I think, in my mind. Um,
Always. So cash is king. I say cash is king, queen, and all the other pieces on the chessboard. Um, and so one thing I've learned is that while it's nice to have a ton of equity in your home, in my world, a ton of equity on paper in my home does me no good. And liquidity is important, and having ready access to cash is important, just on my personal balance sheet. And so when I talked about pulling equity out, and which is something I'm involved in doing now, and hopefully have a closing this week or next, that is really to strengthen my personal balance sheet. And I'm just kind of, I look to do the same thing in my business world. The
yeah.
stronger your balance sheet, the more competitive you can be when you are trying to compete, whether it's for new deals or to kind of strengthen your existing portfolio.
No, super smart, and it's definitely something I would highly encourage people to think about too, just like to that point, because you can't, what I heard the term, like, you can't eat equity. right? It's hard to eat that and create some cash flow so you survive in life. So having cash flow and access to cash definitely is helpful.
Yeah,
So Clive,
it's funny how our kids are picky about what they eat. And to your point, you try and go to the grocery store and say, I've got equity. Can I walk out of here with that cart full of groceries? They'll look at you, laugh at you, and call security. So yes, cash is king.
awesome, awesome. Clive, this was wonderful. I really appreciate you sharing your story and kind of your journey through entrepreneurship, real estate investing. And so for folks who are interested in learning more about your company and opportunities for investments, like how best to kind of connect with you?
Yeah, the easy way is to go directly to my website, which is parkroyalcapital.com. If you go there, that's the best way to connect with me, whether it's to set up a one-to-one meeting, whether it's to sign up for my newsletter, which goes out monthly, or see kind of just general background info about my current kind of endeavors and portfolio. But basically, head to the website. You'll also see kind of the social media platforms that I'm engaged in. And I'm on most of the main ones.
Awesome. Awesome. So it won't be hard to find you. So thanks again, Clive. I think you provide tons of value to folks to consider not only pursuing a different path in life, whether it's through business or even unique investments, but also just kind of life lessons around things. Right? This is investments one piece of it, and running your life like a business is can be a smart idea too, right? Your personal finances, run it like a business, be mindful. And so, Clive, I appreciate your time and energy and look forward to chatting with you soon.
I appreciate you having me on, Tom. This is a great chance to share with you and your audience, and I welcome them to reach out to me.
Awesome. Take care.
Thanks for joining me on this episode today. I really am grateful for you as listeners to the Perennial Pride podcast. I hope you're getting some tremendous value out of it and hopefully pushing you along your journey to financial freedom. I put this podcast together really to help help you get more educated around your finances so that you feel empowered to live the life that you really want. And if you like the content that you heard today or watched, then I would encourage you to go to my website, perennialpride.com. There's tons of other content there. And you can access my book, Wealth Beyond the Numbers. You can buy it there on my website. It's a aggregation of a lot of great tips and tools I've learned to not only build my wealth in my accounts, but build wealth in my life and abundance and joy, and something that has a lot of my experiences in the journey that I've been on personally. Hopefully that can be also of value to you as you sort of move forward. So thanks again for being a Perennial Pride listener, and we'll see you on the next episode.